very unlikely the Fed cuts rates this year. If they do cut rates this year, it'll have to be from an event that's pretty dramatic.
Welcome to the 15th edition of Barnes Quarterly. It's the end of the first quarter of 2023, and we wanted to reach out to you guys just to give you a market update, and of course always visit with our Chief Investment Officer, Chris Zaccarelli, on what's been going on in the markets and in the news. It's a busy time of year. It's Easter week. We also have the Masters Golf Tournament going on. I'm going to be making a pass through Augusta to visit my mom. Unfortunately, I will not be attending the tournament, but it's always nice to be in Augusta this time of the year. We've got a lot going on. Eddie and I are going to be attending a conference up in Savannah, Georgia in May with our Office of Supervisory Jurisdiction, the guys out of North Carolina, Independent Advisor Alliance. Also, we've been busy booking some new business. We picked up a client out in Montana, and we are planning multiple due diligence meetings out there sometime in the future, preferably during elk season and fly fishing season. But Eddie, what have you got going on?
Yeah, I'm planning on several of those trips to Montana myself, just to carry your luggage or something. Other than that, just staying busy with work, and family is keeping me busy as well. 3 young kids. Always a lot going on. One thing you forgot to mention this week, I'm sure everyone's brackets are busted like mine was a long time ago, but the national championship game is tonight.
But without further ado, we're going to ring up Chris Zaccarelli and get him on the line with us. Chris, welcome to this podcast, and understand you and your family were down in the islands for a little spring break action. How was that?
It was great. Really nice to get away, get some nice weather. It was a little bit colder here in Charlotte, so going to the islands was very very welcome. Of course, the timing wasn't great with things going on here in the States with the banking crisis, but other than that, it was mostly relaxing, with the exception of a little extra surprises along the way.
How was the coverage in Turks and Caicos of Silicon Valley Bank's demise?
I can't say that I was reading the local newspapers. I don't think that would have made it in there. But, yeah, the Wall Street Journal Online and Bloomberg were a pretty good source of information where I was. So I was reading pretty closely to everything going on.
Well, and your team back in North Carolina had things well in hand, but that's probably a good place to start. I think that there are probably some misconceptions about what happened with Silicon Valley Bank and subsequently Signature and First Republic. This was not, to my knowledge, a 2008 type of event. And so maybe if you could maybe talk a little bit about what led up to Silicon Valley Bank's failure and the run on the bank, et cetera.
So the banking crisis that we had this year, back in March, was pales in comparison to anything that happened in 2008, which was such a much larger systemic issue, and really had to do a lot with credit quality and the fact that there were so many obscure and hard to value securities throughout the world that cast a real doubt on which banks were solvent or not during the great financial crisis. This time around, there was a couple banks. So far, it seems like there are isolated incidents. There were runs on the bank, and so that's something that has happened in many crises where depositors lose faith in what's happening with the bank, and so just the fact that people withdrawing money tends to make the situation worse for the bank. In this case, Silicon Valley Bank, which was the 16th largest bank in the United States, they had grown very quickly. They're very concentrated, as you would expect, based on their name, on technology companies and venture capital companies based in the greater Silicon Valley area. And so they had a very narrow deposit base in terms of the industries they served. they had very tech-savvy customers where information about what was happening with the bank could travel very quickly, and those depositors were also able to, using technology, transfer money out at a great rate. So I think it's safe to say this is one of the quicker bank runs that we've ever seen in history, and that's technology-enabled. But Silicon Valley Bank was definitely a more narrowly focused bank than you would typically see, at least amongst some of the larger banks in the United States. And what got them into trouble was not credit risk, but actually duration risk. The idea that they had taken depositors' money, which is effectively overnight money because it can be taken out at any time, and they went ahead and used that money to buy treasuries, but they bought longer dated treasuries. So, the full faith and credit of the United States was never in doubt. But the problem was the long-term interest rates that they had locked into were very low interest rates. And as we all know, over the last year, the Federal Reserve has been raising rates pretty quickly. And so Silicon Valley Bank, at least in terms of a large part of their portfolio, which was in treasuries, at least on a statement level, was underwater. They were looking at double-digit billion-dollar losses, at least paper losses. Unfortunately for them, they had to crystallize those losses and sell those treasuries that they had locked in at a low rate at a loss because depositors started withdrawing their money. And we think it started pretty benign. It was just a situation where depositors were withdrawing money from the bank just through normal course of business. They were drawing down funds because they had to use their bank deposits to pay their employees and to basically make up for the fact that a lot of the companies that Silicon Valley Bank services aren't currently making profits. So in order for them to pay their employees, pay their vendors, things like that, they were just drawing down funds. And so at some point, someone noticed that Silicon Valley Bank was actually starting to crystallize losses. And once that happened, there was a run on the bank, as we talked about before. And so instead of them having to crystallize a small amount of the treasuries that they had locked in at low rates, they had to crystallize a large amount. And at one point, they depositors withdrew $40 billion. And so that was really when the regulators stepped in and had to shut down the bank and then bring in other management. So it was a little bit different than what we'd seen in 2008 in terms of it not being a credit crisis for the bank, but it's more of a borrowing short and lending long type of situation where they got into trouble. So it was definitely a little bit different than what you normally would see, at least in 2008, but maybe a little bit more typical of what we've seen in the past, just at a much quicker pace. The speed at which the bank became insolvent has to be one of the quickest on record, I would expect.
So just to kind of recap, the underlying investments of Silicon Valley Bank were AAA credit. Treasuries. The problem arose because of a mismatch in the assets of the bank and the liabilities or the demands on those funds by the depositors, and that's what caused the issue. Now, the Fed has stepped in and sort of shored things up. Obviously, as everybody knows, FDIC insures deposits up to $250,000 per depositor. But the Fed came in and indicated that Federal Reserve came in and indicated that they would basically make depositors whole if need be within the banking system. Isn't that correct?
That's right. They've on a case-by-case basis, they've gone ahead and made sure that no depositors lost money, even if they had more than $250,000 in an account, which many of those accounts were much, much higher than that, especially for businesses, but also they had some pretty wealthy individuals as well. So effectively, they guaranteed those deposits well and above the limit, and they've had to do that once or twice more in addition to that. So I don't know that the Treasury has officially said that they would guarantee deposits to any level, but so far they've shown the willingness to act and to do that. So at this point in time, I think most people assume that if any other banks were to run into a similar kind of problem, the Fed would make them whole as well. So there's kind of an implicit guarantee, at least in the short run, for deposits of any level above $250,000. But that's not something that people should rely on, even in the short run. I would definitely look to put your money to better use, whether that's buying treasuries yourself or investing in the stock market. But having $250,000, over $250,000 in an account is probably not good practice, especially since if it weren't for this type of situation, it's possible a smaller bank could have failed and people would not have had their deposits guaranteed.
Okay, well, thanks for that clarification. So I guess the other major theme that we've been harping on the last couple of sessions is inflation and the interest rate increases that the Fed has been imposing. But the situation with the banks, again, is interrelated, and there's been speculation. I mean, we've had first quarter numbers just in, and the numbers for the first quarter were pretty strong in the stock market. And there is speculation, I guess, because of the stress that the banks have been under, that the Fed might choose to ease up on their increase, which I think is upcoming in May, and maybe take a pause, which seems to be fueling some of the stock market enthusiasm. Am I right about that?
Yes, that's exactly what people have been talking about. And, prior to the banking crisis that we had in March, there was a lot of speculation that the Fed would be raising rates potentially at 50 basis points again, even though they had slowed to 25 basis points earlier. Once the banking crisis happened, the debate went from whether or not the Fed would do 25 or 50, or whether or not the Fed would do 0 or 25 and actually take a pause at the last meeting. And as we now know, they decided just to do 25 basis points. So they didn't take a pause yet, but there's still a lot of speculation out there that because the banking system has been under some stress and the fact that most likely banks in general will be tightening their lending standards and potentially reducing credit to businesses and customers, that potentially that means that the Fed has an opportunity to stop raising interest rates more quickly than currently expected. And so I would probably take it, my opinion is somewhere in the middle. On the one hand, I absolutely think that what's been happening with the banking system has affected the Fed's thinking. I think it's very likely that all things being equal, the Fed probably won't raise rates as high as they otherwise would have had there not been any stress in the system. And that's based on what a lot of Fed speakers had said, including even Chairman Powell himself. However, it may be premature to think the Fed is going to pause as early as next month. There's been a number of Fed speakers that have talked about the fact that they can use certain tools to try to manage liquidity crises like we saw in March. But on the other hand, they can continue to raise rates, most likely at the 25 basis points speed. I think it's unlikely that at this point they'd be raising at 50 basis points or higher than that, given the fact that we've already seen stress in the financial system. But I do think it may be a little premature to think the Fed is going to stop raising rates as soon as the next meeting. However, they probably won't raise rates as much or as high in 2023 as people would have thought they would do prior to the crisis. So we'll have to see what path the Fed takes. But they're trying to do two things at once. One, make sure that the banking system remains solid and stable. But on the other hand, they are still focused on inflation, and to that extent, I think you have to be concerned about the fact that they will continue. They potentially can keep raising rates, even as early as the next meeting.
We just met recently with a representative from Capital Group, the American funds, and the gentleman from Capital Group was saying that their economists or market strategists are saying that they feel like inflation has peaked, but it is going to continue to be persistent, and so that seems like it would. I guess agree with what you're saying about the raising of the interest rates is probably not over, and certainly it would be premature to think there would be rate cuts at any point, at least for the rest of this year, I'm guessing. Is that fair to say?
It is, and I think that's the most likely course. I think the Fed. Let's put it this way. I think some people get a little bit confused between inflation peaking and inflation continuing or prices continuing to move higher. I think the idea of inflation peaking is that the percent change, the month over month or the year over year change, isn't going to be getting any higher than it was last year. And if anything, we're kind of seeing the rate of change slow. So you can almost think of we're decelerating in terms of the increases in inflation. But I think, Capital Group, and we would agree with that, are saying prices are going to continue to move higher. They're just not going to keep moving as high. They're not going to be moving higher at as quick a rate as they have in the past. So on the one hand, inflation is heading in the right direction in the sense that it's decelerating. On the other hand, the absolute change year over year is still 6%, which is triple what the Fed wants. So I think they kind of have to continue to do what they're doing, keep an eye on inflation, hope inflation continues to move back down. But there are some people who are saying the Fed is going to be forced to cut rates, and it sounds like Capital Group is saying they don't agree with that, and I also don't agree with that. I think it's very unlikely the Fed cuts rates this year. If they do cut rates this year, it'll have to be from an event that's pretty dramatic. And I think what we saw last month with the banking crisis was relatively dramatic. Clearly nothing like 2008. But, not only did they not cut rates under that scenario, they actually raised rates. So I think the most likely course of action for the Fed is to continue raising rates at a slow pace, but they've been doing 25 basis points. I do expect that at some point they will pause this year, and then they will likely hold them to the end of the year. That to me seems like the most likely course of action for the Fed. The idea that they would start cutting rates, I think, reflects either a belief that things are exactly the same now as they were after the financial crisis, and I don't believe that's the case. Or it's possible people are expecting something dramatic to happen because the Fed is raising rates, and of course you can never rule that out. No one knows what will happen in the future, and there is always a possibility for some type of bigger problem to arise. But most likely we'll continue on the path we're on now. And, the economy will continue to slow down. Inflation should continue to slow down. And hopefully the Fed can do as good a job as possible managing this very difficult transition.
So with all that as a backdrop, as of Friday's close, March 31st, the Dow Jones Industrial Average was up about a point, and the Dow would represent sort of more established blue chip companies. It's a narrower index, 50 companies. The NASDAQ, which would be more the growth-oriented companies, technology we would think, was up 17% year to date. And the S&P 500, which is the broad index and fairly heavily weighted, I'm guessing, in technology and communications, was up about 7.5%. So this seems to be kind of a reversal of what we saw in 2022, where the old established value companies were sort of leading the way. Here it's the situation's been flipped more toward the growth in technology. And then on the fixed income side, we've seen bonds really firm up, spreads tighten, yields decline. So we seem to be going through some sort of transformation or rotation in the markets. Could you kind of comment on that?
Yeah, it's been a very interesting start to 2023. To your point, we've seen a bit of a reversal of what we saw last year, where those, older, established, more blue chip companies within the Dow Jones average, which fared much better in 2022 than did all those technology companies, is underperforming both the tech index, the NASDAQ index, and the S&P 500. So you're really seeing kind of a reversal of what happened in 2022, at least in the first quarter of 2023. But what I think is really interesting to look at, in addition to the fact that, the NASDAQ looks like it's doing so much better in 2023, and it is, but you also have to remember how much it fell last year. So, last year the NASDAQ fell 33% on the year, and the Dow Jones was down less than 9%. So if you look at the trailing 12 months, let's say, as opposed to just the year-to-date numbers, you're still looking at the NASDAQ substantially underperforming both the Dow and the S&P 500. So another way to look at it is that, the indices that were hurt the most last year are playing some catch up. They are definitely doing a lot better on a relative basis this year, but they're still underperforming by a pretty wide margin. So if you look at the trailing 12 months, March 31st, 2022 to March 31st, 2023, you'll see that the NASDAQ is still down 11%, whereas the Dow Jones is only down 2%. So the NASDAQ has really done a lot to try to make up some of those losses from last year. But even though in the first 3 months of the year, the NASDAQ on a relative basis has really outperformed, a lot of that is just a reversion to the mean of it being down so much last year. So it'll be interesting to see what happens in the second quarter as we're starting today. Even just looking at the markets as we speak, today the Dow Jones is outperforming the S&P 500, and both of them are outperforming the NASDAQ, which is down today. And of course, it's just the first day of the quarter, so anything can happen over the next 3 months. But it's been an interesting market to watch because there's been a lot of back and forth and a lot of reversals of trends. So it's not been a consistent or a very steady market by any means.
Chris, a couple of things to add into that. From what I understand, a good bit of the NASDAQ growth has just come from a very small handful of the kind of larger big name companies that you would expect from some of the earlier cycles.
That's exactly right. Yes.
And then also in some of our conversations with the American funds, they seem to think that moving forward, you're going to have a lot of years where you're looking at single-digit returns, and so they expect dividend-paying companies to make up a much larger percentage of portfolio growth for domestic markets, and then some of the international seem to be a little bit more focused on the growth side. What are your thoughts on that?
I mean, I think it's an interesting point. In history, when we've had kind of more of those range-bound markets which didn't appreciate that much, at least at the index level, you did see quite a bit of returns on the dividend side of things. So even if prices stay relatively constant or stay within a smaller band or smaller range, the fact that those companies that continue to pay dividends can enhance the returns that you'd otherwise get, all things being equal. We could definitely be in a situation where that's the case over the next couple of years. It's really hard to tell. A lot of those dividend-paying companies are older economy, more traditional companies, and so it probably depends a little bit on what happens to the economy as well. If the economy goes back to growing very quickly again, it's possible that we'll see some of those tech companies and some of those companies that don't pay dividends go back to larger appreciation, and we did see a little bit of that in the first quarter. But it's definitely possible that over the next few years we could see a lower growth on the index side, and therefore a higher total return would come from dividends. As far as international is concerned, it's interesting because the European indices tend to be a little bit more like our Dow Jones and a lot less like our NASDAQ. So if it's the case that you think you're going to have much more of your total return coming from dividends than price appreciation, international would probably be a really good place to invest because you'd find a lot more companies that fit that profile versus the U.S. NASDAQ. But with international investing, not only do you have to worry about investing in companies, you also have to worry about the currency as well. So to the extent that the dollar gets stronger or weaker, that could either hurt or help your returns. And of course, if the dollar stays neutral, all things being equal, that would be a factor that's not taken into consideration. But I would argue that if you believe that dividends are going to be an important part of the future, and you think a lot of the dollar strength that we've seen over the last year has been people really going to a flight to safety, either to U.S. Treasuries on the fixed income side, or even to larger U.S. multinationals, those very strong balance sheets, very stable companies, big blue chips, which is what we saw to some extent last year, then it's possible if that trend reverses, you'll see the dollar stay neutral or potentially even weaken as opposed to appreciate. And all things being equal, that's good for international. So I think you could make a strong case for international, similar to the way you can make a strong case for dividend-paying stocks.
Well, and you can also be investing in a U.S. company that is a multinational and is doing a lot of their business overseas and kind of play it that way too. But
that's right. That's a good point.
So we're at the end of the first quarter. What would you, just in a couple of sentences, what would you say to investors? What would be their map for the balance of 2023?
So I would say 2023 is going to be, again, all about the Fed. And by that I mean, if inflation does continue to behave, keep coming down, decelerate, and the Fed doesn't need to be too aggressive, it's very possible that we could have a really strong 2023. There's not a lot of people calling for big returns in 2023 because the Fed has been raising rates, and that is an overhang on the market. But it's very possible that if the Fed is able to go a little bit more slowly and potentially, keep things regulated, but not necessarily push us into recession, then we could have a very good year for the stock market. But there's a lot of unknowns out there. It's very difficult to say how aggressive the Fed is going to be, how persistent inflation is going to be, and whether or not the U.S. economy, which has held up remarkably well, considering the Fed's been raising rates for the last 12 months, if the economy continues to hold up really well through all of 2023, we could see a pretty good picture. And the converse is true as well. It's possible that we do eventually roll over into recession, and if it's a deeper recession, I would expect that there could be some drops in the stock market. On the other hand, if the recession is more shallow, we've already seen the stock market price in a shallow to moderate recession last year. Some of those losses have been recouped, and we've seen some price appreciation, as we talked about earlier in this conversation. But ultimately, the stock market has a good opportunity of going much higher from here. But like everything else, you probably need to be cautious at this point because we are facing some headwinds in terms of a slowing economy, a Fed that is raising interest rates, and potentially other shoes to drop if it turns out that the Fed raising rates is causing problems in other areas besides just the banking system.
Well, and you also have little things thrown in like Silicon Valley Bank and the banking panic, war in Ukraine, and then, of course, OPEC announced production cuts today, which should elevate the price of oil and gas. And then, I guess down the road, the other big sort of looming thing in the future is the debt ceiling discussion in Congress and what's going to happen there. So that's what keeps our jobs always interesting and enjoyable, right, Chris?
There's never a dull moment, and there's always something to worry about. But on the other hand, there's always lots of good things to be grateful for as well. So I agree. It's never a dull moment when it comes to stock or bond markets, for that matter.
Well, as always, we really appreciate your time today, and hope you have a great rest of the week.
Great speaking with you, and I hope the same for you as well.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.